The May inflation report just landed. Headline number, 4.2% year over year. That is the highest reading since early 2023, and financial media ran with it immediately. Inflation is surging. Rates are going higher. Panic. But here's the mistake millions of people are making right now. They are stopping at that headline number, and that number is only telling half the story. Let's talk about what is actually inside that report, because buried underneath 4.2% is a very different figure. Core CPI, which strips out food and energy, came in at 2.9%. That number came in below expectations, and it matters far more than the headline figure. Here is why. Energy prices drove the majority of that 4.2% spike. The war in the Middle East pushed oil prices sharply higher. Shipping through the Strait of Hormuz became unpredictable. That uncertainty flowed directly into fuel costs. And fuel costs flow into almost everything else. But as of today, that equation is changing. The US and Iran agreed to a ceasefire over the weekend. The Strait of Hormuz is reopening. Crude oil just fell to around $80 per barrel. That is down more than 5% in a single session. The very thing driving that headline inflation number is now reversing. Now here is where things get genuinely interesting. Core inflation at 2.9% tells us something the headline cannot. It tells us that underlying price pressures in the economy are actually cooling. Goods prices fell on a monthly basis for the first time in over a year. Services inflation showed no meaningful reacceleration. That combination does not describe an economy spiraling into a 1970s-style price crisis. It describes an economy managing through an energy shock. And energy shocks, unlike structural inflation, tend to resolve. They resolve when the supply disruption ends, and right now, the disruption that caused your rate decision as chair. Markets are not pricing in a hike. They are also not pricing in a cut. They are pricing in a pause. And that pause is where everyday investors need to pay attention. A pause means rates stay elevated for longer. That affects every dollar you carry in debt right now. Mortgage rates remain high, car loan rates remain high, credit card rates, already averaging near record levels, remain high. If you are managing any form of variable rate debt, this week matters directly to your household budget. But a pause also means something else. It means the Fed still has room to move later in the year. If core inflation continues drifting toward their 2% target, if oil prices keep falling as the ceasefire holds, if the data between now and September confirms the trend, that is the scenario where rate cuts become real again, and that matters enormously for the bond market, for your savings rates, and for how much a mortgage will actually cost you in 2027. If you find this kind of breakdown useful, consider subscribing for more practical financial insights. We cover what the headlines miss every single week. Let's make this real for a moment. Think about a family carrying a $400,000 mortgage at a variable rate. Every 25 basis point shift in interest rates moves their monthly payment. That can mean hundreds of dollars per year. Real money, not abstract market theory. Or consider someone keeping $50,000 in a high-yield savings account. When rates eventually drop, those returns compress immediately. The window to lock in today's elevated savings rates does not stay open forever. This is what the Fed pause actually means in practical terms. It is not just a market signal, it is a personal finance decision point. Now let's connect this back to the market itself, because the stock market's reaction this week tells you something important. The S&P 500 climbed above 7,400. Treasury yields fell. The VIX, the market's fear gauge, dropped to around 16. That is a calm reading. Markets are interpreting the inflation data through an optimistic lens. Here is why. Headline inflation high, but driven by energy. Energy prices now falling, ceasefire holding, core inflation below expectations, goods deflation returning, Fed likely to hold, but not likely to hike. That combination is actually a reasonable setup for stocks, not a euphoric one, not a reckless one, but a functional one where the bull market has room to continue broadening. The equal weight S&P 500 is now outperforming the cap-weighted version year to date. That means this is not just a handful of mega-cap tech stocks carrying the index anymore. Financials, healthcare, small caps, defensives, all gaining ground. That kind of broad participation is what durable bull markets look like. But here's the problem most people never address. They see falling oil prices as a clear win. They see markets rising and assume their portfolio is fine. They hear that inflation is 4.2% and either panic or dismiss it entirely. None of those reactions are the right framework. The right framework asks, what is inflation doing to each part of my financial life separately? Your energy costs are about to fall. That is real money back in your pocket at the pump and on your utility bill. Your food costs are cooling more slowly. Services like rent and healthcare are still sticky. Your debt costs remain elevated and will stay that way through at least this week. Your savings rates are still rewarding patient cash holders. These are 5 different inflation stories happening simultaneously, and most people are only looking at one number. So what do you actually do with all of this before Wednesday? First, do not make any major financial decisions based on Wednesday's Fed statement alone. One meeting does not define the rate cycle. Second, if you carry high-interest credit card debt, treat every month of elevated rates as a cost you can reduce. The Fed is not cutting this week. Use the pause as motivation to pay down the most expensive debt you carry. Third, if you hold savings in a money market or high-yield account, understand that these rates will not last indefinitely. The moment the Fed pivots, those yields begin to compress. If you have a medium-term financial goal, a down payment, a business fund, an emergency reserve, locking in today's rates through a short-term CD or treasury bill is worth considering. Fourth, do not let 4.2% headline inflation convince you to exit your long-term investments. Core inflation is cooling. The energy shock that created this spike is reversing in real time. Overreacting to a headline number is one of the most common and costly investment mistakes people make. The May inflation report looked alarming on the surface, but the data underneath it told a more nuanced story, and the weak sophisticated investors chose to believe. Oil prices down over 5%, treasury yields falling, stocks rising across multiple sectors. The market is betting that the worst of this inflation spike is behind us. That bet may prove right. It may need more time. But the framework for understanding it is now in your hands. Next week, this market will look different. Make sure you are watching.